it's completely different model than the stock to flow model. It's not based on stock to flow ratio. It's based on technical analysis, that is price only input. So it will be very interesting to see how high this bull market will go and where we will average out. And it can be anywhere between. It says on average it will be 100K in this 4-year period. And the chart with the confidence bands is, I think, very clear in that as well. That means that we have to go, we have spent 1.5 years below 100K. So we will have to spend a considerable time above 100K to make that 100K average. And I think it's not inconsistent with that the dark blue area should be populated with 67% of the bullets of the monthly closes in that halving period. So we're probably overshooting that dark blue area on the upside, spend some time there, going back, spending another time at the blue area above the 100K level, maybe shoot through that in the bear market a little. But in the end, yes, 100K average, or the model is invalidated, if you will. And also for the confidence bands, I think we should not spend, like Safe said, a lot of time, like 6 months or more, something like that, far above or far below the 2 standard deviation bands, because that's also not compatible with the model. So no, the average value flows from the fact that it's a fitted model through historic data. It is by definition the average. So yeah, that could be one hypothesis, that it undervalues because the market, the printing has accelerated after COVID. But I could also say, well, we really need a lot of printing. We need it to go on, and the model expects that there is a lot more printing. The values that are predicted, 100,000, even $1 million Bitcoin, are outrageous as well. So it sort of implicitly take that accelerated printing into account. That's another thing you could say. And a third thing you could say is to eliminate the fact from money printing. I sometimes make this stock to flow to gold model. I don't measure Bitcoin in dollars, but in gold. So for example, right now, 1 Bitcoin is 37 ounces of gold, but it was below 1 ounce of gold. You could make a exact same model, an exact same regression line, just measure Bitcoin in gold, and then the model it's still valid. It still is a 99 even percent R squared with a very nice fit, linear fit. So, and then you get rid of all the dollar and money printing effect because you measure Bitcoin in gold terms. Recognize the need for trading, or the lure of trading. But I would recommend against it. And in fact, I'm not trading myself. I'm more for it for the long run. I guess hodling is the best way to go. Your risk and return estimation is I mean, if you hodl for 4 years, you would never lose any money. If you just sit and forget and look back at the money for 4 years, that will give you a very relaxed life and almost certainly a certain good result. But then again, I understand, especially if you expect some crashes, that you try to prevent those. And in fact, I would consider that something in between hodling and trading, because trading is a very short-term thing, like daily trading or weekly trading or monthly trading. I don't think that's a good idea, that short-term trading. But if you just want to avoid the next crash, I think that would be a strategy that could be interesting. In fact, I am doing that myself too. And I did it also in 2017. I think it's no secret that I bought Bitcoin in 2015 and 16, then sold half just after the all-time high in 2017, and then bought it back in the beginning of 2019, just before I wrote published the article. I sort of prevented the dip in 2018 a little bit, and I want to do that again. Yeah, but that you have to be very certain and have a very strict strategy, because you will fall victim of your own fear and greed if you don't. You need a method. For me, I would need a mathematical model to guide me, because otherwise I would be ruined by my own greed and fear. All my models are sort of tuned towards recognizing that moment, right? Standard deviation bands, if it's 2 standard deviations out, then I get worried, right? Then I know the top is near. When my on-chain models jump red and I see the FOMO transactions coming in, which are not there at the moment, but when I see that, I know I have to be taking some money off the table. And so, but everybody has to decide about how to do that, how to time that, and if you time that. And some people just say, well, but the risk is also in the dollars, right? If the dollar becomes, if I sell everything, I don't have Bitcoin, I have dollars. That hyperinflation is eating my purchasing power away. So where should I put? I just keep it in Bitcoin, because 1 Bitcoin will stay 1 Bitcoin forever. and I don't mind the volatility. That's the hardcore line, the hardliners message. December is 135,000, and I didn't give any predictions after that, because it's a very short-term thing. It's not like stock-to-flow ratio that I can expound it into in the future for a year or 2 years, or even 10 years. Let's first see those two. And the reason that I can give those two, or actually the last 3 as well, so 5 months in advance, is because we are exactly at this lower floor at the moment. I know we cannot go below it. Theoretically, we can, but then the model, of course, is broken. But because we are at the bottom, I can extend it a little bit into the future. And as soon as we are going to start getting prices above the floor model, then I cannot extend it anymore. I know that sounds like a bit of a mystery, but I did, of course, not publish the model yet. But that's what it is, and it's completely different model than the stock-to-flow model, because it's not based on stock-to-flow ratio. It's based on technical analysis, that is price only input. It's basically exploiting a mathematical error that most technical analysts do, because technical analysis was made for normal markets and not for Bitcoin exponentially growing markets with non-normal distribution. That's the third model, of course. So the stock-to-flow model, the data fits the stock-to-flow model best, right? If we look at the historical data of Bitcoin, like the charts we have spoken about, it fits the stock-to-flow model best. But the stock-to-flow X model also takes data into account in the fitting from gold and silver and real estate and diamonds. In comparing those markets, and that's why it's called the cross-asset model, you get a different line that's slightly steeper, hence the higher price of 288,000 on average, right? I think that's the fundamentally better model, because that compares store value alternatives for investors. But the fit with the pure Bitcoin data is better. The way how I look at it, it's the stock-to-flow model is the base case model, and the stock-to-flow X model is the best case model. It's the fundamentally better model, and I think so they're not exclusive, mutually exclusive as well. So we could go to 100,000 this year, say end of December, and then we could go further and further, right? We could rise further and maybe have a peak at, let's say, a top at 300, 400 somewhere 2022, and then and still keep averaging out at 288 later on. I don't dismiss that thought at all. So it will be very interesting to see now how high this bull market will go, the second leg, and where we will average out, and it can be anywhere between 100 and 288. That's how I see it.